At various points throughout the year, we've looked at the difference between cash and profit, and it's a really important distinction to make. And the reason is bills need to be paid. You can't run a business without paying your bills, and we want to make sure nothing becomes overdue and we can always pay our bills on time. If we can't pay our bills, such as creditors, utilities like the electricity, wages, insurance, buying stock, if we can't pay those bills, we just simply go out of business. And what we would like to know is that, or what we need to recognize, is that bills aren't paid with gross profit. They're not paid with net profit. They're actually paid with cash. So while we spent some time calculating some profitability ratios, for instance, we looked at gross profit margin and net profit margin, we don't actually pay anyone with profit. We pay them with cash. So what we'd like to know is, well, how could Enron, a business with profits going up, except for 1997, every year, to be a huge $979 million by 2000, how can it go broke within the space of 12 months? Obviously that means it couldn't pay its bills, but how can it not pay its bills if its profit is so high? Similarly, Lehman Brothers, its profits have gone up to went up to about 4.2 billion by 2007. Doesn't mean it could pay its bills though, because they went broke within 12 months in 2008. An Australian example we've looked at is ABC Learning, so its profits aren't nowhere near as big as the other two, but they are going up every year, and in that last year they almost doubled up to 143 million. Doesn't mean they could pay their bills because they went broke within the space of 12 months. So what we'd like to know is that, or how can we figure out whether a profitable business can actually pay its short-term debts as they fall due. So things like expenses, creditors, we need to settle our GST, loan repayments, drawings, etc. What we're going to use to do that is a series of ratios called liquidity ratios, and they analyze the ability of the business to meet our short-term debts as they fall due. So note there's kind of two parts of that definition. Can we meet our short-term debts, which is important, but importantly, or even more important, is it says as they fall due. Not can we pay June's phone bill in September, can we pay June's phone bill in June? So we want to make sure liquidity measures whether we can pay our short-term debts as they're actually due. And to do that, we're going to look at three ratios: the working capital ratio, the quick asset ratio, and the cash flows ratio.